Hello everyone, I am Dr. Pooja Sharma. I'm going to explain you the concept of leverages. Leverages, if I'll talk about the leverage, it is very important term in deciding the capital cost of capital or deciding the capital structure of the company. So again, it is important, very important in the financial planning of the corporates. And leverage analysis for the business, this picture shows that if you want to increase, if you want to push up something, so you have to you have to use the leverage concept in the business. When you have to increase the profit, you have to analyze the leverage. When you have to increase the EBIT of the company, EPS of the company, and wealth max, you have to increase the earning of the company. You have to use this concept to decide your cost of capital structure. So again, it is related with the corporate financial planning. In this, after studying this topic, you should be able to identify to understand the concept of operating financial and combined leverage. You are able to calculate and interpret a firm's financial degree of operating financial and combined leverage. You can understand the profitability statement for evaluating the financial decision, and you are able to understand what is involved in determining the appropriate amount of the financial leverage for a firm. So leverage have the different meanings in the different subjects. As in mechanics, leverage means an instrument that helps in us in lifting heavy objects, and which may not be otherwise possible. And in financial management, the firm's ability to use fixed cost funds to magnify the return its owners. When the company has to increase the profit of the owners or the shareholders. Company has to use the fixed cost in their capital structure. So this concept is related with that. The term leverage is used to describe the firm's ability to use the fixed cost assets or funds to increase the firm's return, basically, for its shareholders. The term leverage refers to a relationship between the two interrelated variables. The variables may be output, cost, profit. It can be anything. Finance manager calculates these leverages by applying the formula, then uses these leverages for decision making in favor of the shareholders. The use of excess debt means when the company will use debenture capital more than the equity share capital in their capital structure, and on high fixed cost creates both financial risk and the business risk. And for calculating the such extent of risk, the concept of leverage is being used by the company. It's a investment strategy that is related with the borrowed money, specifically the use of various financial instruments, or with the borrowed capital. Leverage can also refer to the amount of debt of a firm uses to financial assets. Whenever the company is using the financial fixed cost or the fixed instrument to um, raise the earning or the profitability of the equity shareholder, that is called the leverage. So here we have studied about till now we have studied about the different aspects of the different concepts of the leverage. Now the types of the leverage: operating leverage. There are three types of leverage: operating leverage, financial leverage, and the composite leverage. Thank you so much. In next lecture, I'll teach you about the calculation part of the operating, financial, and the composite leverage, and its importance in financial decision making. Thank you, sir.